Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. One of our favourite guests here is Chris Brycki, the founder and CEO of online investment advisor Stockspot. Usually we're talking about market volatilities or exchange-traded funds, gold, things like that. Today we're going to talk about super. Remember, this is general information only. You should get professional advice before making any investment decisions. Chris, welcome back to Fear and Greed.
Thanks for having me back on, John.
So I want to start really broad on super and then drill down into it, because we all take superannuation for granted, and since 1987 it's been legislated as such. There's plenty of arguments to say that sort of forcing people to give their money away to save for retirement isn't fair. But the super system as a whole, do you think it works pretty well for Australia?
I think it works all right, I would say. Look, there are different approaches for saving for ultimately the retirement of your citizens. Some countries take the approach of the country itself managing that pool of money and then dishing it out, whereas in Australia, basically a part of your salary goes towards super through your working career, and then that money builds up. You've contributed throughout your life, and then you access that money in retirement. Plus, you still get access to the age pension and other government support. Look, in the whole, I think it works pretty well. It's not perfectly fair, and I think there are challenges. One of them that's often pointed out is the big difference in super balances between males and females because of the time that women's been out of the workforce, and also big historical salary differences. So there are a few elements that may be considered unfair. The big element that we always point out, our Fat Cat report, that we think is unfair is fees, because it's not something that I think a lot of Australians understand very well, super, and the impact of fees. People don't really shop around that much. And so there isn't competition like you'd see for groceries or for electricity. And as a result, the costs are too high. But, problems aside, I think as a whole, it works pretty well.
Is the system, because the industry super funds have done particularly well and they've advertised on fees broadly, and then the retail funds, the corporate funds, what's growing, what's not growing, where are people putting their money?
Well, it's interesting. Like, the advertising around fees has always been a relative advertisement. So the industry funds are great at pointing out that they're relatively cheaper than retail funds. That's right. However, if you actually zoom out and compare industry funds to the funds in other countries, they're very expensive. And different think tanks, including the Grattan Institute, have pointed this out, that in other markets where there's more competition, so in Chile, there's a good example where there's a tender process to basically win the pension money. And as a result, the fees you pay in Chile is more like 0.3% per year, versus in Australia, the average is still closer to 1% per year. So fees are lower, certainly in industry funds, and that's what's been driving their growth over the last 10 or 15 years relative to retail funds, which were just too expensive. That's starting to converge a little bit. A lot of the retail funds have been shutting down, and so really only the better ones seem to be surviving. And we're seeing that in our Fat Cat report now, that a lot of the duds have been shut down or are merging. And so I expect that difference will probably slim over the next few years. And then the area that chugs along in the background and is always doing pretty well is self-managed super funds. So that accounts for a pretty big chunk of the overall super pie. I believe it's around $600 billion of assets in total. And that's people that decide to take control of their own super.
Stay with me, Chris. We'll be back in a minute. My guest this morning is Chris Brycki, founder and CEO of online investment advisor Stockspot. Okay, if we think about how super money is invested, and less so DIY, but mostly the big funds, the boss of BHP, Mike Henry, recently, when they announced their big profit, said 70% of Australians will feel this. He meant because people either hold BHP shares directly or via their super funds, which is presumably that's correct. But the thing about super, which for someone like me, I might have BHP in my industry fund that I have, but I could also have alternates. I could also have private equity, all sorts of asset classes that me as an individual, I don't really get access to.
That's right. When you invest in super, they're investing across a range of different assets typically. So you usually get to choose between what's known as a diversified fund, which invests in lots of different assets, or you can buy or invest into a single asset fund, which would be something like Australian shares or global shares. Now, most people will pick a diversified fund, and certainly the My Super options out there, which are a lot of the default options people get through their employer, are diversified. And the diversified mixes have a range of different assets in there, including Australian and global shares, government bonds, corporate bonds, property, infrastructure, private equity, credit, hedge funds. There's all sorts of different things that fit in there with the idea of giving people a mix of different assets and a more smooth return path over their lifetime.
And it works?
It does on a whole. I mean, our research shows that actually there's a limit to the benefit of diversification across lots and lots of assets. So what you tend to see is there's a few key asset classes that tend to provide great diversification benefits. But then incrementally, as you add more assets, and a lot of these other assets, you're only putting 2, 3, 5% of your super in, they tend to move in the same direction as shares, really. And so they don't give you too much of a benefit. The problem with some of these assets is that their fees are so high that any benefit that they may be able to get is eroded by this extra cost you're paying for them. So I would say some of these other assets, the benefit is marginal. One of the groups of assets that I think there's a lot of discussion and debate around is the broader group of unlisted assets. So there's a whole range of different assets that trade on public markets like share markets and bond markets where their prices are observable every day. You can see what share price BHP is trading on or what price their bonds are trading at. But there's a whole bunch of different assets that their prices aren't observable. So a shopping center in Hawaii, for example, or a toll road. And these are the assets where more of our super money is going into, and it's very hard to measure over shorter periods of time whether they're actually adding value or not.
Yeah, I mean, the example of Sydney Airport going private earlier this year into super funds is an example of that. Is that right? Because it's an unlisted asset now. We can't value that, or we only value it every 6 months or 12 months, or the super fund does, presumably. So you're not quite sure what's happening in your fund. Is that what you're getting at?
Yeah, that's right. So the privatisation of Sydney Airport or Crown are great examples of public assets getting taken private. And then vice versa, there's often private assets that go public and will list on our share market. And so you do see over time assets moving in both directions, getting taken off public markets and put back on. It actually raises quite a good point, is that unlisted and listed assets don't exist in their own world. They're constantly being compared to similar assets on listed markets.
When we talk like this, it just makes you realise how important the role of the superannuation trustee is, because as a member, I'm really relying on that trustee to do the right thing by me.
Yeah, that's right. So you're relying on them acting in your best interest and making sure that your money is sensibly invested for the long run. And yeah, where they're making decisions to invest in any sort of asset, whether it's listed or unlisted or different asset classes, that it's adding value to your portfolio.
Now, this is not an investment podcast, so I just stress that to the listeners. But super, it is a tool which people should think of as part of their whole investment spectrum.
Yeah, that's right. I mean, people do also have often investments outside of super. A lot of people own their own home as well. So super is just one part of, someone's overall investment mix. For a lot of people, it's quite a big part of it. So apart from your family home, for a lot of Australians, it would be the second biggest pot of money that you have.
Now, Chris, I can't actually let you go without talking about earnings season just a little bit, because we are in the midst of it. It's a very big week this week for earnings. What anything that you've noted so far?
I mean, earnings seasons for mine is always one that I like to let go and let others try and pick which stocks are going to surprise to the upside or downside. My general observation, and I used to run trading strategies, focused around earnings season, is that it's not so much about the headline earnings that matter, but around the market expectations and then also the forward guidance that companies provide. And so picking which stocks are going to surprise to the upside or downside, I think, is notoriously difficult. A lot of fund managers will try and, position their portfolios to try and work out what's going to go up and what's going to go down. But the stats just continually show that it's not a great strategy. And we've done some research recently that showed that about 80% of Aussie fund managers continue to underperform over the last 5 years, and it's about 97% of global fund managers. So it really shows that there's just such great competition between fund managers betting against each other to try and work out earnings season. Then, as an investor, what you're best off to do is not to try and play that game, and instead just stay invested and let earnings season wash through and then continue to invest for the long run.
Okay, so your answer there just ties the super and the earnings season together. Why is it then that some super funds who are investing money, and sometimes they're investing actively, they're fund managers, why do some of them just always outperform. I think it's Host Plus, actually, and I think Australian Super's another, which 1 year, 3 year, 5 year, 10 year, on the tables, they always seem to be doing relatively well. And given when you perform 1 year, you got to do even better the next year, but some of these guys keep doing it. Why? Is it a process thing they've got? Is it smarter people?
So there's a few reasons based on the research that we do that we can see why funds may outperform over different periods. Like the biggest driver that we see tends to be fees. So fees compound year after year after year. So a fund charging 2% has almost no chance of outperforming just mathematically because that becomes such a big drag on their returns over the long run, whereas a fund charging 0.5% per year has a much better chance of doing well. So costs are one. Being positioned in the right asset classes is another one of the bigger drivers, and it's certainly a much bigger driver than actually picking the right underlying stocks. So if you've got a bit more, for instance, invested over the last 10 years in global shares rather than Australian shares, you're likely to have done better. And then the third that certainly is noticeable over this year is the amount of money in unlisted assets. So the funds that we've noticed perform the best over the last year, and a lot of them have then looked good over longer periods, have a really big proportion of their overall money invested into unlisted assets. And this is a good and bad thing. The good thing is if you're someone redeeming now and you're drawing out of your super, you're managing to get a great price because you're essentially able to sell those unlisted assets at a good level. The challenge I see is that a lot of these unlisted assets, it's a bit of a black box in terms of what they are, how they're valued, how often they get revalued, who performs those valuations, and what methodology they used. And it's becoming quite obvious that funds aren't valuing all of these assets very regularly and comparing them to listed assets. So there might be big differences. So, where you might see some tech, high growth tech stocks falling 80% on our share market over the last year, held privately via a super fund, they may not have been marked down at all, or they may only be marked down 20%. So you may be overpaying for them. And eventually those two numbers will have to converge, but it may take some time. So this is an area we've been pushing the government and regulators to really look more closely at, because I think it has the potential to cause a lot of intergenerational inequity in super, because people putting their money in now may be disadvantaged and people taking their money out may be getting a better price.
Chris, thank you for talking to Fear and Greed.
My pleasure. Thanks for having me back.
That was Chris Brycki, founder and CEO of online investment advisor Stockspot. This is the Fear and Greed Daily Interview. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.